Well, let's get a wrap of the day that was and the month that was, and where to from here. Martin Crabb from Shrank Partners joining me here in the studio. Martin, welcome back.
Thanks to be here.
After this big rally we've seen, lots of hopes out there about maybe a more tepid interest rate hiking cycle from central banks around the world. How are we looking from a valuation perspective for the market?
Yeah, I mean, valuations have certainly come back, Scuddy, because what we've seen is negative price action, notwithstanding the rally you spoke about, which kind of started in the middle of the month. But earnings have been revised higher. So it's kind of the bond market's flashing, there's a recession coming, the cash futures are telling you there's a recession coming, the credit spreads are telling you there's a recession coming, but analysts are still upgrading earnings. And why is that? Well, mostly it's on commodity prices and inflation. So people can see the price of wheat and wool and copper and steel and everything else, so they're upgrading. They're not really thinking about what does this do for downstream margins. They're almost like waiting for the white of their eyes to move the numbers. So we've got this sort of lag delayed effect where the market prices have come off, earnings are still being revised up, and so PEs have come tumbling down. So I think I had a look at the ASX 100 PE, it's on 14.2 times, and the small ordinary is also on 14.2 times. So both the large caps and the small caps have come down a long way. Those numbers were both over 20 not that long ago. So we've had a massive contraction in PEs, but I just think maybe the E's, E needs a bit of thinking about. Are we going to have higher earnings than we had a couple of months ago with all this inflation and with all these financial conditions tightening around us?
Do we get any of that inkling in the confession season that's it's still going per se, but I know a lot of it's been run and done for the stage that we saw during that period?
Yeah, well, obviously we're taking our cue from the US reporting season because we get those every 3 months, as you know. In Aussie, it's really, we got through the May, the May conferences. There was a number of conferences. In fact, there was an ag conference on today. There's a small cap conference on last week. There was the big Macquarie conference earlier in the month. So we kind of got through that relatively unscathed. But obviously now that we're getting towards year end, those companies that the CFO is sitting down with the board and going, yeah, based on the first 4 months of the year or the first 5 months of the year, maybe we're not going to reach guidance. So we're starting into the squeaky time of the year. If we can get through that, into June, July, August reporting season, we'll really see the whites of the eyes. But my sense is that consumer demand's slowing, and we're seeing that. Commodity prices and inflation is higher. That's got to be lower margins for a lot of industrials. We're just not seeing signs of that yet.
Given that mix of high commodity prices, no concerns maybe about the consumer side and the demand side of the picture moving forward. Is that going to be impacting what you like in the market at this stage?
Yeah, very much so. So one of the big arguments out there, Scuddy, is that there's this pile of cash, right? There's $2 trillion of excess savings in the US. So there's 300 billion of excess household deposits here, but they're not in the hands of the people who are going to spend it. And the people that do have those cash buffers, and a lot of people do have cash buffers, are going, well, I know that my fuel prices are going to be higher. I know that my food price is going to be higher. School fees are always higher. Medical insurance is always higher. And I'm probably going to have to pay more interest on my mortgage going forward. So those people are reluctant to spend that. So that 15% of GDP in dry powder that's supposed to fuel the consumer sector, people are now starting to think, well, is it? So I still think consumer discretionary and even staples like supermarkets are sectors that still look pretty expensive to me. I mean, Woolies is still on high 20 times PE. I just don't, with the markets on 14, that doesn't make a lot of sense to me.
What about real estate? It's an area that's pretty, influenced, of course, by what's going on with bond yields, interest rate outlook and the like. How do you judge the performance that we've seen over the past month in that space? Because we know that, for a large part, we've just been seeing bond yields ratchet higher, and it's just started going to impact. You've got a chart here.
Yeah, well, this is just the ASX 300 real estate sector divided by the All Ordinaries Index. And you can see that, obviously real estate got belted in March 2020 in the COVID sell-off because no one was ever going to go shopping ever again. But since then, it's been pretty good. It's rallied quite strongly. But just since the start of this year, there's been a big sell-off. And this month has been terrible. I think the REITs are off 8%. And the market's probably ended off 2.5, 3. So there's a big underperformance. So you think right now, with people going back to work, with people, with opening up, people shopping again, and with interest rates potentially rolling over, maybe we're seeing the top of the 10-year bond, that you'd start to see some money going to the real estate sector, but it's just been an absolute dog. And the real reason for that is really a handful of stocks. Goodman Group, So Goodman Group's down 15%, was down 20 this month, and Charter Hall. So Charter Hall has gone from being the absolute rooster of the sector to the feather duster of the sector. So people have really gone off that stock. So really disappointing. It's probably a sector you would expect at this point of the cycle with inflationary expectations picking up, because a lot of the rents are linked to inflation and bond yields just starting to roll over a little bit. You'd expect that more defensive nature of real estate to shine through, but it's been a disappointing sector for investors.
We had Chris Bedingfield from Key Global Investors on the program earlier on today, and giving a bit of a sense as to how he sees some of that industrial play at the moment. A lot of it comes back to what Amazon reported for the first time in almost its history, at an excess capacity in its warehouses. Some of those big retailers as well warning about inventory overhangs, which potentially looks to maybe spare capacity moving forward. When you look at a company like Goodman, outstanding company, but are the best days now gone?
Yeah, look, I think it's probably a 7 to 10% EPS growth story for 5 or 10 years, based on what we see happening to e-commerce more broadly, and the fact that they've got a really good footprint of sites that they're just going to continue to roll out. I think what happened though, Scuddy, was the market got ahead of itself on valuation. It did think that Goodman was a 30 times or a 25 times PE stock. The reality is it's that growth rate's great, but it's not such that you would want to pay up. And it's not dissimilar to a Domino's or a Xero. The investment case is still there. It's just the valuation the market put on that earnings growth. So I think the slowdown in e-commerce, which Amazon highlights, that probably hasn't helped the case either.
How are you feeling about the global growth outlook right now? We saw China's PMIs out today. Still a contraction, but not as bad as what was feared, and certainly an improvement from what we saw in April. Lots of people talking about global growth concerns, hard landings and the like.
Yeah.
Are you buying into that?
We're still seeing growth slowing. So I've just put a group of PMI. So the PMI data comes out as a flash, and then it comes out as an actual a couple of weeks later. So we've had the US, we had China today, we've had the EU, and we've had Japan, and those four economies obviously make up a big chunk of global GDP. So this is just May's numbers there, and you can see that May continued to be softer than April, notwithstanding that China went from 47.4 to just under 50. So China's got a bit better, but if you group them together, we've still got slowing global growth. And as you get the other countries coming in around that, you'll find that that's a continuation, particularly through Europe. I mean, Europe's clearly slowing. So countries are slowing for different reasons, but they're all slowing. While that PMI data is heading lower, markets don't tend to do well. So the two things we look at, financial conditions tightening and global growth slowing, they're two things that just keep us cautious. So the outlook for global growth is continuing to see that slow going forward.
I couldn't help but notice as well that on the energy space, we saw the leaderboard before we came to the conversation. A few of those names on the list there. WTI crude futures are breaking to new highs. People are talking about potentially going past those highs we saw a few months back at the start of the war. How do you look at the energy sector? Because it's one of those ones where a lot of people say, well, a lot of good news has been priced in, but can that continue?
Yeah, the poison and the cure is the phrase we use. So oil is probably the biggest existential risk to portfolios, because if it continues to get out of hand and continues to run, it's going to cause more and more inflation, which means more interest rate hikes, which means slower growth. So you really want to have a hedge against that in your portfolio. Now, if you've got ESG issues and you don't want to invest in fossil fuel, you have to look at carbon offsets. So you can go and buy carbon futures via either ETFs or in the futures market. So you can look to offset the price of carbon through that, or you can do what we do, which is, or we do both, buy Woodside shares or Woodside Energy shares and Santos shares. So just give yourself a chunky weighting in energy in your portfolio. I think we've got about 12 or 13% of our large cap core portfolio in Woodside and Santos, just because if oil continues to go up, and it's not crazy to have $200 oil, it's quite feasible it's going to happen. Not saying it will, but if it does, imagine what it does to the share market, right? It's just going to cause chaos. But Woodside and Santos shares will be significantly higher, at least giving you some hedge against that. So I think that's the best way to play it.
Do you want to stick with those really high quality balance sheets as well, names in this kind of environment?
Yeah, look, you could be cute and try and go for a marginal producer that has a high cost, because that gives you the leverage. But really for us, it's about, these stocks are on single digit PEs. They're absolutely printing cash. They're paying big, in often cases, fully franked dividends. So you're getting the cash flow back today. It's not like you're holding these for the next 20 years. In fact, you probably don't want to own them at all over the next 20 years. But just right now, they're a hedge to your portfolio. So go with liquidity, go with quality, go with the bigger names.